Hi class, this video is a second in a series of videos on recording depreciation for Unit 4 accounting. And this one is going to focus on straight line method of depreciation. So if you haven't watched the first video entitled Introduction to Depreciation, I encourage you to do that one because it does explain in more detail what straight line method of depreciation is. This video, if we think about the learning intention, the full learning intention for this series of videos on depreciation is I hope that you'll be able to understand how to describe, calculate, record, and apply depreciation. This specific video will focus on how you calculate, record, and maybe think about and apply straight line method of depreciation. This will focus particularly on our general journal, general ledger, and we maybe will think about how this will impact our accounting report, specifically the income statement and balance sheet. So what is straight line method? Straight line method depreciation is a method used for assets that have a consistent revenue earning capacity over the life of the asset. What do I mean by that? Assets have the same revenue earning ability regardless of their age. Remember, depreciation is allocating the cost or the usefulness of the asset throughout its lifetime, because it is more than 12 months, and it would be overestimating the value of the asset if we keep it on our books at its historical cost. Straight line method is when we have assets that are going to have a consistent revenue earning capacity. What are some of the things that you should be looking at if it doesn't say what method of depreciation to use? It's typically ones with not many moving parts, because these moving parts will mean that it's not efficient over its lifetime. It'll get worse at earning revenue. So in recognition of this, straight line depreciation means we're allocating a constant rate of cost throughout the asset's life. An example of this would be office furniture. Office furniture is such an asset that has very few moving parts. And often office furniture or desk has a consistent revenue earning capacity, whether it's the first year, the fourth year, or honestly, as it keeps going. It will consistently create the same amount of benefit to the business each year. So how do we calculate straight line depreciation? The formula is as follows. Depreciation per annum is cost minus residual value divided by its estimated life. What do I mean by these three terms? Because remember, this is how we calculate the depreciation expense for each period. Cost is what we went into in the first video. Purchase price, but importantly, all the other costs incurred to get the asset into a revenue earning capacity. So all the other costs that might get into the condition or location ready for sale, freight in, modification, all those sort of stuff, but we don't include recurring costs. Residual value is the estimated value of the non-current asset at the end of its useful life. Often we understand that assets, when they're at the end of its useful life for one business, still means that we can sell it, trade it in some terms that we'll come across later for a certain amount of value. So we might have a business an asset that is going to have its residual value at the end of its life of a few $1,000s. Its useful life is the estimated period of time for which a non-current asset will be used by the entity or business to earn revenue. We measure that in years. Let's look at an example that will make this clearer. And importantly, before we do this, and we will talk about this in class, note that two estimates, residual value, how much it's going to be worth at the end of its life, and its life are estimates. What do we know about estimates? They are not 100% going to be what happens. So that might have an impact on the verifiability, relevance, and faithful representation. And we will discuss this conflict potentially between estimates and a few of the characteristics in class. So let's consider an example. On July 2022, an office desk was purchased for cash for $1,400 plus GST. There were some other costs involved, a delivery cost of $200, yearly insurance of $50. There is an estimated useful life of 4 years, an estimated residual value of $200. And we know that we now have to work out the depreciation using this formula. Residual value here is given to us, $200. Estimated life is given to us 4 years. What was the cost of this asset though? Remember, cost is the purchase price. Here it is $1,400. GST has nothing to do with it. But do we include the delivery cost or insurance into this cost? We just include the delivery cost. Why? Because this is to get it into the asset into a condition ready to earn revenue. It must be delivered to our business. The yearly insurance is a recurring cost. It is a period cost, not anything to do with the cost of our asset at the start. So we now have a formula. Our cost is $1,600, $1,400 plus $200. We must subtract the $200, giving us $1,400. This is basically the amount of asset that is going to be used up in our business. Starting at $1,600, going down to $200, we're going to use $1,400. And there is 4 years of which it will take to use up that. It is going to occur in a constant rate. So we go 1,400 divided by 4 means we have $350 of depreciation expense per annum per year. And you will be required in Year 12 accounting to make these calculations, do this calculation yourself. Then we've done that, and that might have been the end for general maths. We need to think about how we're going to record this in the world of general journals. Let's think about it before we go on. What has happened? What are we recording? We are recognizing that our assets go down. And we recognize that there is a cost associated with using up our assets. Costs, expenses, assets going down is going to be a decrease in our asset. So how are we going to record this in our journals? We are going to record a debit called depreciation of asset. And when I say asset, I mean writing in the asset that we are talking about, and I'll show you an example in a second. This one is an expense that increases. Expenses that increase are debits using Paler. We also understand that our assets are going to go down. Assets going down is a credit, and this way we record this in our general journals is the credit of accumulated depreciation of asset, and here we have a narration. So for our specific example of our office furniture, it will look like this. In a year's time, we will record an expense of $350 for depreciation of office furniture. Expense increasing is a debit. An accumulated depreciation of office furniture is our credit, which reduces the value of our assets. Assets going down as a credit. Adjusting entry for depreciation straight line method is a simple template narration. And if we knew the source document, which we would in an example, you would then write that in your narration. What do we need to know? Remember here that the depreciation of office furniture is a expense. Accumulated depreciation of office furniture is our negative asset account. Once we've done that, and you can see this is in the top right hand corner of this slide, we then use this information to post to our ledger accounts. We've got our instructions, we post it. The first one we're going to do is depreciation of office furniture, and it has to be a debit. Debits are left hand side. So we'll find our depreciation of office furniture ledger, like so, and record on the left hand side on 30th of June a $350 debit. The cross-reference is always the credit. If we're doing a debit, the whole $350 cross-reference is result of our credit to accumulated depreciation of office furniture, and you can see this is an appropriate abbreviation. Why is there a profit and loss summary on the right hand side? I will come to that in a second. We then come to the credit. We are going to find the accumulated depreciation of office furniture, and on our credit side, write $350, right hand side, and our cross-reference is our debit, depreciation of office furniture. So to summarize, the depreciation account depreciation of office furniture is an expense account. What do we do to expense accounts at the end of each reporting period? We have to close them off because this is an expense. This is going to impact our profit. Hence, we are closing this to make this expense account balance or be zero, however you want to think of it. So we post that to profit and loss summary. This will be a new one that you might close if you're determining profit, closing revenue expense accounts. Our accumulated depreciation account is actually a negative asset account. It is reported in the balance sheet, and I'll go through how we report it in a second. But if you think of this as a negative asset account, this is how we reduce the value of our asset that we know is going down in value as we use it up. So the difference with depreciation is we know that we're going to hold this asset for more than 1 year. In fact, this office furniture we're going to hold for 4 years as it goes from $1,600 down to $200 in value. So after 2 years, our depreciation of office furniture is going to have another journal entry, which I haven't shown here, but I have shown the ledger. We have another $350 of expense that will be reported in our income statement in our other expenses section. And because it's another expense, we're going to close it again in our P&L summary account. The negative asset account, accumulated depreciation, also accumulates a reduction in the asset because our asset is worth $350 less after 2 years. So on 30th of June 2024, we post another credit. This means, beg your pardon, if we look at this now, you can see that we have a balance, because we would balance this at the end of each reporting period, of $700 of accumulated depreciation of office furniture. So how much is this office furniture worth now after 2 years? Thinking all the way back, we valued it at cost of $1,600 and it has gone down in value of $700. So we would expect after 2 years that we are reporting this as a $900 asset to faithfully represent it. So how do we report this in our balance sheet? Accumulated depreciation is a negative asset that is deducted from the cost to determine the carrying value, how much it is worth at the point in time. Using our understanding that we've just talked about, we understand that it is going down in value by $350 per year. So it's going to look like this for each extract of our balance sheet. We will now, for our non-current assets, list the asset, office furniture, and you can see from 2023 all the way to 2026, we are still reporting the historical cost of $1,600, but we now have a new line item underneath it called less accumulated depreciation, which keeps increasing by $350 a year, which shows how much our asset is actually faithfully represented worth. So for example, as we talked about, after 2 years, it is not worth $1,600 anymore. It was $900. Why are we showing this, both the accumulated depreciation and the original bit? Remember, this accumulated depreciation is all estimates. It's important for people to understand how much we bought it for, how much we valued it at, and then these estimates of how much it's going down. So we now have our historical cost and our carrying value. And guys, from a lot of questions, that's where we end. But what are some other things to consider? Very, very often in business, unlike this previous example, we buy the assets throughout the year. This has been simple because there's been an assumption that we purchased it on the 1st of July and conveniently the reporting period ended on the 30th of June. So there has been a year, always been a year from when we bought it to when we did a reporting. So we could really conveniently work out depreciation on a yearly basis. But what would happen if the furniture was purchased on the 1st of July, 1st of March, and the period still concluded on the 30th of June? Clearly, we can't say the asset has gone down in value by a full year's worth of value when we bought it only within the year. So how do we work this out? We always calculate depreciation for a whole year like we've done. But for the very first year that we do it, we need to determine how long the asset has been under control of the entity and adjust appropriately. For example, if it was purchased on the 1st of January, we have only used up 6 months of value by balance day. 1st of March, we've only used up 3 months by the balance day. So if we look at our depreciation for a part of a period, we would need to adjust it. This depreciation of $350 per annum actually is $29.16 per month. So if we purchased on the 1st of January, our first 6 months will be a debit of depreciation expense of $175 and a credit of accumulated depreciation of $175. 3 months, $87.50. For the next period, and the periods going on, we will always use up the full 12 months because it's kind of assumed we've controlled the asset from the first day of the reporting period to the end of the year's reporting period. So full year depreciation would be allocated. Again, this is complicated in theory, but be always looking out for it, and examples and more questions will help. So what do we need to know? We need to always be looking out when the reporting period is less than 1 year. It's a very common exam question. And then we need to be thinking about what happens when we record that. Do not simply assume that each reporting period is 12 months or that we've held it for a full period. You need to be looking and reading your questions and doing your adjustments as appropriate. So by now, hopefully you would get to the point where you would feel comfortable looking at an answer question like this. We bought an asset of $1,000 on the 1st of April. It is a 12-month reporting period ending 30 June. So April, May, and June, we have 3 months used up. The asset is assumed to have a residual value and an estimated useful life for 2 years. Hopefully we can get comfortable at being able to report this, and it's practice that will make us comfortable with questions like this. But in conclusion, hopefully you leave this video being confident, understanding the theory on how you calculate, record, and apply straight line depreciation in both journals, ledgers, and accounting reports, particularly that balance sheet and income statement. Well done for listening, and keep practicing your depreciation questions.